accounting for partnership formations. So we have to record. Our requirement here is to record or to journalize different contributions of partners. So we record partners' contribution based on agreement, based on the fair market value if it's determinable, and if it's not determinable, we compute or we solve for the net book value of that asset. So let's record. Partners, Dean, Guy, and June agreed to form a partnership who contributed the following. Letter A. The partners agreed to the value of the assets to be recorded. Once the partners agree as to the value of the asset to be recorded, so we will use that agreed value. So the partnership received computer agreed amount 90,000. So disregard the cost, we will record the amount. So letter A, debit, computers 90,000, and credit gain capital for 90,000. So if there's a partnership agreement as to the value of the assets, we will record it based on their agreement. Letter B. The partner has no agreement, but fair market value is determinable. So if the fair market value is 95,000, disregard the cost, use the fair market value. So for letter B, we'll use, so what's the asset? Sofa. So we'll record furnitures and fixtures. We will use the fair market value of 95,000. Credit to gun. So gun capital 95,000. Letter C. Partners have no agreement on the fair value of the assets to be recorded. The fair market value is not determinable. So God invested desktop 100,000. Purchased exactly 2 years with an estimated useful life of 5 years. Here we have to compute for the depreciation of the assets. So please check my other videos as to how to compute for depreciation. So for now, we will compute for the depreciation of that asset. So this asset is 100,000. So depreciation is equal to the cost of the asset minus scrap value, if there is, divided by the estimated life of the asset. So depreciation for this desktop is 100,000 minus no scrap value, so 0, divided by useful life of 5 years. So that means this asset is to be depreciated 20,000 per year. So if this asset is purchased exactly 2 years ago, that means 20,000 times 2 years. So 40,000 is already the expired portion of this desktop computer. So that means 100,000 less 40. So we will record letter C for 100 minus 40, 60,000. So debit, so that's desktop computer. So again, you can record it as computers, or you can record it as office equipment. So computers, 60,000, which is 100,000 minus the 40,000, and credit good capital for 60,000. So again, to record contributions of partners, if there is an agreement between the partners, so we will record assets based on their agreement. So 90,000 for letter A. If there is no agreement, use the fair market value if it is determinable. So in this case, the fair market value is 95,000. If fair market value is not determinable, and also there is no agreement between the partners, we have to compute for the net book value of that computer. So net book value is equal to cost minus accumulated depreciation. So depreciation for 2 years, 40. So your cost, 100,000 less 40,000 accumulated depreciation. So your net book value is at 60,000. So again, if there's an agreement, agreed value. No agreement, but with fair market value, use fair market value. No agreement, no fair market value, sold for the net book value of the asset. On January 5, 2020, Sir Yoso decided to venture together with his college classmate, Mr. Yang Wan. Mr. Yoso invested 50,000 cash in a store equipment in a market value of 60,85. Again, the order of priority is, if there is a partnership agreement, we record it based on that agreement. If no agreement, we record the fair market value of that asset. If there's no agreement, no fair market value, we record the net book value of the asset. So in this case, the store equipment has a market value and a net book value. So we will prioritize market value. So we will record first the investment of Mr. Seryoso. So Mr. Seryoso invested 50,000 cash. So number one, the partnership received cash, 50,000. Then a store equipment with a market value of 60,000. So we will freeze our screen. 60,000. So debit store equipment 60,000. So that means Mr. Seryoso invested a total of 110,000 in the partnership. So credit Mr. Seryoso capital 110,000 in the partnership. On the same day, Mr. Watt transferred all of the following assets and liabilities of his personal business to a company. So when we account for partnership formation, it could be two individuals who wanted to start a partnership, or it could be two existing single proprietorship who will combine their assets. So in this case, it's new venturer and one existing business. So on the same day, Mr. Watt transferred all of the following assets and liabilities of his personal business to the company. Let's check their agreement. Okay, here's the balance sheet of Mr. Watt. Here's the balance sheet, and here's the partnership agreement. The partnership is to assume all of the liabilities of Mr. Watt. When we say the partnership is to assume all the liabilities, meaning all of these liabilities will be transferred or will become part of the partnership liabilities. So that's what we mean when we say the partnership will assume the liabilities. The liabilities will be transferred to the books of the partnership. If the problem here says the partnership will not assume, so meaning this will become the personal liability of Mr. Watt. It will not be transferred to the books of the partnership. Let's deal with that later. Let's continue with this assumption that all of these liabilities will be transferred to the partnership books. So later we will record liabilities as well. Accounts receivable is 85% collectible. So out of 45,000, it is 85% collectible. So, another agreement here is that merchandise inventory is undervalued by 5,000. Merchandise inventory is undervalued at 5,000, and office equipment is valued at 115. Okay, let's go one by one. Okay, we will transfer all the assets of Mr. Watt to the company. Okay, number 2, let's transfer. Cash and cash equivalent, no adjustment. So we will record full cash and cash equivalent at 25,000. Accounts receivable, 85% collectible. So debit, accounts receivable, 45,000, and we record here allowance for bad debts, which is 15% of 45,000. Since 85% is collectible, that means 15% of 45,000 is uncollectible. So 15% of 45,000 is 6,000. 15%. So 15% of 45,000 is 6,075. So 45,000, 6,075 is 6,750 rather, sorry. 15% of base accounts receivable is uncollectible. So that means 6,750 is uncollectible. Next, merchandise inventory. Merchandise inventory here has adjustments. Merchandise inventory is undervalued by 5,000. So that means its fair market value is plus 5,000, 170. So we record merchandise inventory 170,000. Office equipment is to be valued at 115. So again, based on partnership agreement, it's 115. So we will record it at 115. So debit office equipment 115. Next, the partnership is to assume all liabilities. So we will record all liabilities. So accounts payable 26,500. It says all. So accounts payable plus loans payable. Credit, loans payable 100,000. So now we have Mr. Young Watt. Young Watt. Young Watt capital, which is the net of all of this. So let's solve. Understand Mr. Watt is 221,750. So to highlight, to recap, you record all of this based on partnership agreed amount, based on its market value, and if the partnership requires adjustment, so we will follow whatever they agreed for adjustment. Here's another issue. Focus on this. Office equipment is to be valued at 115. So straight away, we record office equipment at 115. While accounts receivable is said to be 85% collectible. We still record accounts receivable at 45,000. Then we provide allowance for bad debts for the 15% uncollectible. So there's a difference between valuation of other assets like inventories and office equipment versus accounts receivable. We do this meaning we use the allowance method because of the possibility of the collectibility of these 6,720 uncollectible accounts. So that's the difference between adjusting accounts receivable versus the rest of non-cash assets. So that's how we record partnership formation where one of the partners are already existing single proprietorship.